hello to all of the audience. We're here with a panel on raising the bar, building financial inclusion for everyone. Very excited for this panel and the conversation we're about to have about the sort of existential purpose of fintech. So I hope everyone is kind of ready for a pretty deep conversation. I'm the moderator. I'm Heidi Moore. I am a digital media advisor, which means I advise news startups on how best to increase their reach, their engagement, their content. My background is as a financial reporter, at the Wall Street Journal, bureau chief at Marketplace Radio, which runs on NPR, started the business and finance section for The Guardian, and then moved into consulting and working with newsrooms. So I'm going to throw it over to each of our panelists and have them introduce themselves and how they got interested in financial technology. So Christina, let's start with you.
Hi, everyone. Good afternoon. My name is Christina Chaney. I hear a little bit of an echo. Hopefully that's not me. Okay. So my name is Christina Chaney. I head up sales and relationship management, the national footprint for mobility capital finance, better known as MoCaFi. And so MoCaFi is a Black-owned fintech. We are New York City based, and we are looking to close the financial wealth gap, help people build their credit mindset, help them build wealth, take them on and access to building generational wealth, and also getting access to capital. And so we've got a nice FDIC insured free bank account, as well as some other financial services and resources. And so happy to be here today and love chatting with the rest of the panel. So thank you.
Excellent. Thanks. Sharla, do you want to tell us a little bit about your background?
Sure. My name is Sharla Godbehere. I lead the AltFi and FinTech team at Equifax. I've actually been with the company for 25 years. I live on the West Coast. Although we have been a proud sponsor of Boston FinTech Sandbox for many years, with my history within financial services, just being on the West Coast and seeing FinTech kind of start to blossom years ago, made me very excited to see where we can go and where we could change this very legacy and mature industry. And I really see FinTechs driving a lot of that change, especially as it relates to financial inclusion. So it was made perfect sense for me to jump in and start exploring that more. And I'm happy to say we now have a nationwide team focused specifically on FinTech and really helping startups and all FinTechs of all shapes and sizes really mature and grow in their adventures.
I also want to add, for anyone who doesn't know how to pronounce Sharla's last name, it's a sentence, Godbehere, which is a really nice declarative sentence and perhaps a good sign for our panel. So Hannah, do you want to introduce yourself? Tell us a little.
Sure. Yeah. Hannah Arnold. I've been in and around the fintech space for 4 or 5 years now, initially with F-Prime Capital, investing in early stage fintech companies, and now at a fintech company myself, Argyle, which facilitates access to user permissioned real-time income and employment data, often for lenders targeting borrowers who are traditionally viewed as high risk and excluded from the financial system as a result. So I actually came to the fintech space for the impact promise. I studied policy in school. My very first internship was with an impact investing firm, kind of was the big vision for my career. And overall, I think, there have been some disappointments. Not all fintech companies are doing good, but I do really strongly believe fintech is moving the needle in the right direction. So excited to be part of this conversation.
Excellent. Thank you. And Castleigh, do you want to introduce yourself?
Yes. Good afternoon, morning, evening, everyone. Hopefully some people are globally watching this. Castleigh Johnson, CEO and founder of My Home Pathway. Our platform is a fintech, prop tech / social impact platform geared towards making home ownership equitable. Over the last, 50 to 60 years, we've realized home ownership has not been equitable. The numbers speak for themselves in terms of the home ownership gap, still at 30 points. And that's something that we have to address, and that's what our company's focused on. How do we create more access to home ownership across all consumers? So we take what traditionally considered, I would say, higher risk consumers that may have lower credit scores or higher risk profiles, and we build them a path towards gaining home ownership. And again, creating an opportunity for lenders to really access a market that they wouldn't have necessarily serviced before. So again, my background, about 15 years in financial services, anywhere from the New York Fed, AIG, Goldman, Bank of Montreal in the risk space, and really truly looking to make financial inclusion more than a 15-minute fame spot. And it's not just a sexy one-time thing that we can talk about, but truly enabling financial services to provide access equitably across all products and services, and take it away from a sentence or a mantra into a business as usual process. And I think that's where fintechs are really looking to create opportunities to be more efficient and to be more equitable.
Mm-hmm. And we're definitely going to talk more about that. I think that's actually what makes our panel kind of interesting. To give the audience a summary of what we're going to talk about, we're going to cover a few topics. One of the themes of the conference so far has been, how do we have financial health for everyone? With our panel of experts today, we're going to talk about some of the paradoxes and some of the systemic issues that underlie how do you have a fintech reach underserved consumers and also through technology solve a lot of emotional and cultural issues, including trust, including creating customer bonds when you're doing that through apps, through computers, through credit scores, and so on. And so it's really interesting because what we're really looking at is, if you have AI making human decisions, how do you keep the humans in it? And more importantly, how do you create a point of opportunity for those humans as opposed to, just one more app to check or one more piece of technology to manage or to be judged by. I'd also like to thank FinTech Sandbox and the team there, Kelly Fryer, Josie Matalas, Jim Smith, and, for having us. And for the audience, I'd like you all to, if you have questions, please drop them in the chat. We'll be addressing questions at the end of the panel. We'll leave about 10 to 15 minutes. So please participate there, follow along, make comments. We're reading all of it, and we're really interested in your engagement as well. So I want to start with the first question or the first topic for our panelists. One of the biggest issues for fintech is that it's kind of at the forefront of building trust, with the financial system, which has been kind of bruised especially since the financial crisis, perhaps before that. There are issues of race, there are issues of class, there are issues of, banks that don't really aren't comfortable with shifting all of their systems towards underserved consumers or towards consumers at all, just being far more comfortable with institutions. So my question to our panelists is, what is the role of fintech within that? And, what are the systemic issues that you think about each day in your work? Christina, do you want to start?
Yep. So I would start with saying, sharing a statistic that in a lifetime, people of color will pay in excess of $40,000 in fees and usurious fees for their banking. And so at MoCaFi, we believe in ways in providing opportunities to get them access to get into the financial ecosystem and therefore, understand, why they should have a bank account. What's the importance of having a bank account? What's the importance of not paying a bunch of fees for the bank account? What the bank account can do for you in terms of the journey of building credit and therefore potentially getting into the space where you can have home ownership. And then another way to build wealth in this country is to then become a small business entrepreneur. And so we want to give you the tools to be on the journey to build wealth over time, spend smart, get access to financial information. And that information is available in our mobile app. And so our app is downloadable through the Google Play Store or the Apple Store. And so our company was started 5 years ago by an ex-JP Morgan executive. He was the most senior African-American executive at JP Morgan. He ran one of the largest P&Ls for the bank, and so profit and loss centers for the bank. And so with that, after seeing things that were going on in the city, he said, I believe that my skills, and his name is Wole Coxon. Sorry, I wanted to mention his name. He said that I believe that my skills can be used better to make sure that people of color know what's available. And if we don't educate them and share this information and make it accessible and bring them into the financial ecosystem and start them on a journey for building generational wealth, then we're doing a disservice with all this knowledge that we have. And so the way that we look at sharing that knowledge is that we we have an FDIC insured MasterCard branded debit card. We also have a dispersing product, and we also are building out a savings product and a small business product that is slated to go live in the first part of 2022. And so with these tools and putting them on the journey, the user experience journey of getting this information, getting access to this bank account that is free to them. It's free across the nation, and access to free ATMs, because a lot of these communities that we are talking about today don't necessarily have access to traditional brick and mortar branches. So in their neighborhood, we see that there's banking deserts. We see that they don't have access to this. And so this mobile account, this platform, this financial services as an infrastructure, this technology, the plumbing, if you will, that allows them to get a mobile bank account, allows them to have access to load cash onto their card by going into a CVS, Walgreens, Walmart, Family Dollar, these stores that are in their neighborhood. And so we want to be able to share this information. So I'll stop there and let one of my colleagues jump in, Castleigh or Sharla.
Yeah, I'll jump in. Again, as Christina was saying, a lot of it is education and access. And so how do we provide more education, more access, but education with the tactical benefit of changing behavior and improving financial decisioning? Because at the end of the day, that's what you need to do for a lot of communities, is if you improve decisioning in terms of focused on outcomes. So, building wealth through home ownership, building wealth through business ownership, building wealth through smarter decisioning. How do you spend your money mentality? So some of those very tactical things, unfortunately, just have not been provided to a lot of everyone in the community as well, right? So I think, again, what MoCaFi is doing, things that we're focused on, 70% of middle America's wealth is their home equity. Let's just kind of pause on that for half a second. So if I literally limit your access to home ownership, I can literally limit your access to building wealth for you and your family. Intergenerationally, I can put a roadblock. So that's one of the bigger challenges in terms of giving access, but making sure that, again, the people that you're giving access to understand things like credit scores, understand things like cash flow, understand things like leverage, debt to income. What does that mean? Because those are some critical elements within their everyday decisioning and how they go about their financial lives. Because again, this is not taught in high school. It's not taught in college. So where are you going to learn this stuff, right? Unless organizations like ours create that, the groundswell and the material, and not just material in terms of a PDF. Here's some PDF around financial education, go learn it, is creating kind of that more embedded, material and connective things that people can relate to, right? So you're taking complex financial terms and processes and you're breaking it down into everyday layman's terms that people can then soak in and say, hey, this is what I need to do when I face this, right? This is what APR means, interest means, utilization. So all of that stuff is then how do you make it so simple that, a third grader could get it? That's when you start making progress. That's when people are like, oh, I'm not intimidated by this financial jargon, because at the end of the day, a lot of this stuff is intimidating, right? So you're asking people to make optimal decisions on information that they're not familiar with. So that in itself is, kind of sets you up for failure. So I think it's on us to kind of understand that, those within finance, and say, how do we take what we know or the things that we're used to and make it super accessible? So I think that's where fintechs have the opportunity to kind of, again, be the speedboat in this process and say, hey, how do we make that easier for the average consumer?
Yeah, I really love the way that you frame that. I mean, I think if the onus for financial fairness is on the individuals to learn the rules of a system that aren't necessarily, what you might think, like you pay off, a debt, not always a positive impact on your credit score, like these types of rules that are really learned, not instinctual, or not something that you would ever learn if you weren't taught. I think like the tools and actually automating some of this stuff, helping individuals just meet these rules and improve their credit as a result through actual automated tooling and behaviors, I think is one really great way to build trust. I also, with MoCaFi, it's such a great example of, there's been this proliferation of neobanks that are serving particular communities. And I think as we talk about trust, like we have to think about, like, there's certainly a positive element going on there too, where it might be, a neobank for an underserved community. It might be a neobank for an immigrant community. It might be a neobank for a YouTube influencer, whatever it may be. But I think having your bank speak your language probably goes a really long way towards generating some of that trust that was kind of took a hit over the past 20 years.
I would agree. Yeah, definitely.
Yeah, I think it's really a combination of everything that you guys have said. It's really a matter of educating consumers on what's available out there and how to make smart choices. If you can't afford something, you shouldn't buy it, regardless of what avenue that you have to do that. If you don't have that money tree in the backyard, don't spend beyond your limits. And I think a lot of people do that. So there's definitely a whole education factor for consumers to really understand what's available out there, what their options are. But then, as you all mentioned earlier in our conversation, it's about providing the right products too, and really making sure that those are available to consumers. But I'm going to take it to one level further, and that is where I really see fintechs driving growth. Financial services is a very mature industry, and there's some very large companies out there that are still going to be touching all of our consumers, regardless of what fintech startup you create. But what you all are doing is really driving that education, not only for the consumers, but also for this financial services industry. And I applaud you all for that, really in sharing these stats and bringing that to light, because that's what's going to drive change. And still, if consumers can't get their FICO scores or Vantage scores up to a certain range, they're still going to have a hard time getting a mortgage, right? Or getting a job, or getting a small business loan. It's going to be challenging. They need to understand that. But the financial services industry as a whole also needs to understand the impact that they can have on these consumers. So I think that everything you guys are doing and starting these companies really focused on these areas is critical to our change as an industry overall.
And so one of the things that I think nearly all of you have brought up is this issue of trust around inclusion. Absolutely crucial issue. There's a lot of history here, right? Like, let's be candid about that. And so, within that history, why have underserved consumers been reluctant to engage specifically? And how can you address that, knowing how hard it is to reach them? And how do you reach them?
So I'll say partnerships, working with agencies or working with not-for-profits or community-based organizations. Sharla and I know each other. Equifax Foundation is a very big partner of MoCaFi, and we work together to do things in communities so I'll take St. Louis, Los Angeles, Detroit. Those are markets that are very key markets for the Equifax Foundation and for MoCaFi. And we look for ways to partner with local on-the-ground communities as well as the foundation to really get the word out. Equifax has the data, has the tools, and really is important. And financial inclusion is important to them. And so because they're an agent that has the data that backs a lot of the systems and tools that we use, they're very interested in working with fintechs like a MoCaFi to make sure that we're putting the right messages out there and make sure that we're sharing the financial education and literacy that are important as to why you need this information, why you should be on this journey. And so I think it's important that when you're going to these communities that you are, bringing in the right partners and the right people to share the message, people that they see every day. So if it's a United Way or an Urban League or a local faith-based organization that they work with, it helps when you come together to talk about resources and access to resources that are in these communities and why this information is important and how it's going to help them. If you take them on a timeline or a path on the journey, if you do this, if you pay your rent on time for 12 to 24 months, this is how it increase your credit score. When you increase your credit score, then you qualify for credit and for a mortgage, and then what that does for you. So as both Sharla and Castleigh have mentioned, the home ownership journey and being able to qualify for the credit to start that path to building wealth is so key to the audience in this space that we're trying to bring into the financial ecosystem and giving them the tools to do that. And we've all got tools here in this panel that are wonderful tools that they can leverage in these resources. And so we have to tell the story, get the story out there, and then back the story up with the tools that are tactical tools to get on the journey and continue on the journey. And then so we're telling them why, we're telling them what, we're telling them how, and then assisting them along the how to facilitate the how. So
can I ask you a follow-up question about that? And I'd like everyone else to kind of talk about this too. What is the single biggest objection or fear that you prepare for when you're dealing with underserved consumers? The thing that they keep mentioning.
I can take that really quick, and I'm sorry to cut you off, Christina. Rejection.
Rejection. Yes, I was going to say. I was thinking about, was it fear of fees or rejection? It's both, right? Rejection and then
rejection is the easy one.
Yep, rejection is
the easy one. Fees, you at least got access. They're just now printing money off you. So
Yeah.
Unfortunately.
Well, isn't it rejection and maybe the unknown too? So if I get into this, I'm not going to know. I don't really understand the terms and conditions of what I'm signing up for. I don't really know what that means. I mean, buy now, pay later, as we're calling it, FinTech 2.0, right? It's the hottest conversation out there. Mm-hmm. And one of the reasons it's so hot right now is because it's simple. You know, I make a payment, same payment, 4 payments every 2 weeks, and it's very simple. I think the confusion, people don't want to admit what they don't know. So if I don't understand something, do I want to try it because I don't understand it? Is going to get me, is it going to cause problems if I don't understand what I'm getting myself into? So the more we can simplify things, I think the better as well.
And like T's and C's. So T's and C's are terms and conditions. And so we all know that they go with any type of credit, whether it's a consumer card, a business card, or a loan. The T's and C's are there. But we've got to get simplistic in all of those long language, those T's and C's, terms and conditions that people are filling out because they don't know what they are and they're just signing it. Sorry, Hannah. Go ahead, Hannah.
No. I just was going to ask, I mean, do you guys think we're using language like it's fear and people are unwilling, but there also is a genuine access problem here, right? Like, do you think it's more fear and unwillingness, or like that people cannot get access to services because they're like kept out?
True, absolutely. So the reason why we created our bank account is we don't check the check system. So typically when you walk into a traditional large bank that we know, and I won't say any of the names here, but some of the large banks that we're all familiar with. And so those banks check the check system. So if you're in the check system, you're going to be denied and turned away and not be able to get a bank account. With our mobile banking product, we're not going to turn you away. We don't check the check systems. We're looking to check fraud. And so for fraud, meaning that you really are who you say you are. So that your ID and the picture that you take of yourself when you're in the app match up and that they make sense. And so we're looking for our financial security tools are looking to make sure that we verify your identity, not to keep you from actually getting a bank account. So the check system has gone away. We use a lot of Equifax and TransUnion credit tools in our app. So we have a Vantage score that we provide for you. So that's looking at how you pay your bills. It's trending versus FICO. So we decided to go with Vantage versus FICO. There's a difference there. And Sharla and Castleigh can go into deep dive on that. But just sharing some of the terms that are out there of ways that we try to look to alternative ways that we try to look at making sure that people get access into the financial ecosystem to start with.
Yeah, I'll jump in really quick on the back of what you said in terms of trust. So it's to me, it's 2 simple things, right? Transparency, and Christina just touched on it, T&Cs. If I don't understand the T&Cs, like how can I actually know what I'm signing up for, right? I need a lawyer to go read the T&Cs to describe to me what I'm signing up for. And an average, middle America person doesn't walk around with their lawyer signing all these in any credit thing, even a credit card application, right? If you actually read the T&Cs on a credit card application, they're terrible. I mean, let's just keep it really blunt.
Yeah, and isn't it designed not to be read? That's the other thing.
And again, we know this. So the part of it is in that whole transparency aspect. And again, UDAP rules and all that stuff from a regulatory standpoint in terms of putting as much onus on financial institutions to try to describe as clearly as possible what they're doing. There's a reason for that because folks have purposefully tried to not make things transparent. So, I think transparency is a big one overall in terms of financial services. Let's truly be transparent both from an institution standpoint, again, it's a consumer standpoint as well, and then just having the right intentions. I think that's one of the huge ones that we can, dance around all of the stuff that we're talking about, but having the right intentions. Are your right intentions to truly provide access, or you're just trying to find a different way to milk as much fees and money out of certain communities as possible? And people will smell that eventually, right? So that's why they again have this distaste or distrust for a lot of financial institutions that come in and say, hey, we're here to help you, but we're really not. We're just trying to see as much we can get as much money out of you as possible, and then kind of on to the next, right? So I think it's truly having the right intentions to serve and create true value for folks. Because yes, not to say that you shouldn't make money in revenues and whatever, but you're creating value first, and then you can extract, again, some equitable revenue out of that for whatever financial institutions. Again, banks are technically utilities. If you don't think about that from an actual executionary standpoint, almost all financial services are technically utilities, right? So I think we just have to be really clear around what the intention of these to build a better, robust, more, economy, to build, a thriving economy for all, right? Didn't say build a thriving economy for a few, and then some of you guys will survive for the next 80 years. Let's try to make that something that's encompassing and make a bigger pie for as many people as possible. That's how we'll continue to grow our economy. And so I think that's where, just having true transparency, true intent of, hey, we're trying to really build something for consumers. Yes, we'll also get paid, and yes, we'll make a healthy profit. There's a difference between healthy profit and predatory profit. And exactly. So that's a clear definition that truly needs to be made and execute on that.
And I'd like to take that one step further too. I would say the transparency also needs to be with consumers on what this means to them in the long term. So there are consumers out there that believe that they can live outside the financial services industry. They don't want a credit card. They don't want a mortgage. Especially a lot of our young people today, they're, buying a car. Why? I can use Uber. Buy a house. Why? When I can, use Airbnb and move around regularly. But really understanding the impact. Like, you need to establish a financial history in order to do a lot of things, because those credit checks are done on employment. They're done on small business loans. If you really want to thrive in this environment, and we're in a great situation in the United States, you have that opportunity to really be very successful, but you need to build that credit and you need to do it wisely. So I think it's more than just, it is transparency. These are our fees. This is what's going to happen, but really understanding the good and the bad, right? You establish credit, it helps you in the long run. You don't pay your bills, it hurts you in the long run, but you really do need to establish that foundation and have the transparencies with the consumers as well to make sure that they understand the true impact of what their actions.
I also have a follow-up question for Castleigh. I mean, in terms of making the distinction between positive profit and predatory profit, how do you codify that, right? Because what happens very often is, everyone starts with good intentions or fairly good intentions, and then over time, it sort of starts to go off the rails a little bit, especially as organizations get larger, new people come in, potentially there are future acquisitions to think about, and it becomes a run for ambition, right? And a run for size and a run for having to create as much value for shareholders or stakeholders as possible. So, for organizations who are approaching this and fintech companies that are approaching this, how do you codify a culture of, positivity in the sense of actually helping people as opposed to, squeezing all the profit that you can out of a product?
I think it starts with your North Star and your leadership. Right, it's pretty straightforward to me. What is your North Star as an organization? And you can codify that. So there, again, a lot of large organizations, for example, Ray Dalio at Bridgewater Associates, right, has like this 100-something page principles thing that he has on the internet that you can look at it from outside, but internally, that's what the organization believes and truly operates under. So set your North Star. We're truly here to help people, and we'll make a profit at the same time. But if your organization and your North Star switches, where it's now, let's try to get as much, like, let's look at 80% margins and grow that and no matter what, we have to stay at 80 to 90% margins. So at that point, you're going, and you said a key word, stakeholders, not just shareholders. When you take stakeholders, the community, your consumers, your regulators, all of these pieces are stakeholders in your organization, right? What you're trying to help to achieve. And again, the regulators, and I used to be a former regulator, have the guardrails, operate, fairly within the guardrails. The consumers, you're having to provide good value products and service to them. So you want to make sure that they're okay. Your shareholders, you want a good return for your shareholders. Again, all of these, things, and they don't all have to have, disparate impact across each other. So I think that's where we just have to be very, open to society, and especially financial services, right? There's this moral hazard and too big to fail thing, which kind of, again, bails out by a lot of times large organizations that are super greedy, right? And so there's kind of that known thing, but how do you make sure that we have hey, for you to be able to have this, kind of implicit thing on the back end, you have to provide value to all of the consumers that you're out there serving. And unfortunately, again, the numbers speak for themselves. That has not been the case in financial services, right? That's why we have opportunities for what Christina's working on and what I'm working on, because financial services has not been as equitable. So I think, again, when you align that North Star stakeholder mapping, right, we have to serve all these stakeholders appropriately and not just say 90% of my focus should just be on my shareholders and my return. That's when your North Star gets out of whack, right? And you will do anything to go get that, 90% focus on the shareholders. And that's where you end up in these really interesting circumstances that are not beneficial to everyone in the environment, right? How are we building a sustainable company that also impacts positively the environment? So I think all of those things as a leadership or part of the organization, you have to focus on. And so that would be my feedback on that one.
What does everyone else think about sort of the stakeholder versus shareholder question? I will say that, as I've seen in my reporting, generally, if companies are thinking about their stakeholders, it becomes hierarchical and shareholders are almost always at the top, right? So how do you think about that? Do you think about that? How do you kind of place that in the calculus of how you do your work? Anyone can jump in.
Yeah, I mean, one thing that we do at Argyle, we serve lenders, but ultimately we're also serving end users who are the ones that permission the sharing of data from their payroll systems to a third party that they want to work with. And so where our clients are lenders, in most cases, lenders, neobanks, all kinds of actors in the financial services system, we actually contract directly with the end user. And part of the reason for that is to ensure that we promise them we will protect their data. We will protect the security of their data. We will make sure that any client that wants to access it can turn off, it leaves a way for them to turn off access. It's not the end all be all of how we kind of ensure this intention in our business, but I think as one little hack towards how do you make sure that things are aligned in the right way, actually the way that you structure yourselves legally can make a really big difference as to who do you report to between customers, end users, individuals, stakeholders, et cetera. I'd say as a result, we are in general less focused on helping consumers better fit themselves into a system that frankly has not worked for them, and instead helping lenders readopt and change those rules and actually work outside of the system to meet the consumers where they are and find different ways to underwrite people that have been really left out for a very long time.
Mm-hmm. And I think, to that point that you're making, Hannah, about, kind of the system also having distrust of the consumers, right? This isn't distrust that goes just one way. And I think, Sharla has spoken a little bit as well about how consumers have to sort of earn the trust of these institutions or these companies. And traditionally, the way that has been done, at least over the past, decade, 2 decades, has been FICO scores. And I think, it's been so common for everyone to think about consumer debt in terms of FICO scores that we don't remember a time before, but it was actually imposed. And so I kind of want us to talk a little bit about, the role of credit scores as kind of the center of consumer finance, consumer outreach, how they're so important, why they're so important, whether they're changing, and, you know, and also how that plays into, you know, the role of fees, cost, access to consumers, because it all starts there with the credit score. So I open that up. Sharla, if you want to start, I know you know quite a bit about
I'd love to start. It's one of my favorite topics. No, FinTech is my favorite topic, but credit scoring. So I've been in the industry for a very long time, and I've been with Equifax for 25 years. So I do remember a time when credit scoring wasn't really the norm. And honestly, credit scoring became so popular because it really did normalize the process a lot more. You went from individuals reading credit applications and credit reports to actually allowing scores to make those decisions. They were supposed to remove a lot of the bias. Now, as we discussed the other day, they may not always be accomplishing that, but that really was the goal, was to keep much more consistency and take bias and personal opinion out of the process. And of course, that was a long time ago, but I think that you continue to see scores change. And the interesting thing is people always talk about scores. I get this all the time. I work with a lot of credit builder companies and buy now, pay laters. And they're like, how is this going to impact the credit score? And I'm like, well, which credit score would you like to talk about? Do you want to talk about FICO? And then FICO has multiple versions of their credit score. Do you want to talk about Vantage? Or how about the fact that every lender out there basically has their own score? So, you know, when you really talk about scores, it really is a way of trying to automate the process, the decisioning process, to make things more consistent. Now, mortgage, I'm sorry, that's a different world, right? You really do have the FICO, and Vantage is going to, you know, make its way into the mortgage environment. But that really is what drives a lot of it, and why it's so important. I think that consumers truly understand what scoring really is. It's definitely come out very popular. You can get your score on any, through many different avenues, but the question really is understanding, what does that overall mean to you as a consumer, and how can you impact that? I think it's very important.
And what are there are also, FICO is a kind of AI. And one of the things that we know about AI is that it takes on human biases because it's coded by humans, right? And so it tends to be a much criticized measure, especially for marginalized people and marginalized communities, right? Like, FICO and credit scores initially started so that you wouldn't have people at banks making specific decisions based on somebody's face, their race, their class, about how they would get access to loans and access to funds. But, there is a kind of complaint that FICO and the credit score system has perpetuated that, even though it was meant to solve it. And so how do we approach that problem now, especially when fintechs are the ones, kind of closest to consumers in many situations?
And I can take that real quick. I won't talk too long, but the one thing I love about fintechs is it's not all about the score. It's not all about the credit history, as Hannah can attest to, right? It really is looking at everything, looking at alternative data, which is kind of a buzzword, but truly understanding, what, income has a big impact. We saw that last year, right? Income really had a big impact for consumers. Mm-hmm. And I think that's what I love about fintechs, is they can easily pull in multiple different data assets as part of their overall process. So they're not just looking at these scores, that are looking at, what's in a credit file and possibly zip codes, or they're looking at the bigger picture. And that's really where I see us as an industry, fintech, driving the change in the broader institutions in the financial services ecosystem, is through the use of every data asset out there that we can possibly leverage that can help consumers.
Mm-hmm. And Castleigh, do you have any thoughts about that in the work that you've done?
Yeah, I know we only have a few minutes, so I'll keep it super short so the other panelists can jump on. I think, previously in banking, you had relationship loans, right? That's literally how they made loans. Is the 363 rule of banking. You took in deposits, you paid them 3%, you made loans at 3%, you made 3%, 363. And then my banker had to have a relationship with you to issue you a loan, right? I knew your grandpa, I knew your mom, your aunt. That's how I made loans, relationship loans. So again, when we get into banking, more FICO scores, around additional ways, data elements to take away some of that subjectivity from those loan decisions. Unfortunately, that didn't work. And like the numbers speak for themselves, right? If we had 43% Black homeownership before we had this thing called redlining, where bankers and others would literally circle minority communities and say, we're not lending to those communities. No matter if you have $1 million, we're not lending to you, right? So you had a cascading effect from 50, 60 years of this head start that other communities had. And then you stop at that point and say, hey, now we're going to take you from now. And we're going to look at all you guys equally, but you had a 60-year head start. So how does that make sense, right? That's the actual the thinking that we need to do, right? So, and then the other part of that is then you take something like payment history that doesn't take into account rent reporting when the majority of minority communities are renters.
Right.
The other side of that would be a mortgage payment, which other communities get credit for, but these other folks don't. Again, we got to take critical looks at our infrastructure and be like, this doesn't truly add up. It doesn't make sense. And I think those are the hard conversations we don't want to have. And where fintechs are coming in like, oh, we'll help you solve that. That's literally what we'll help you do.
Yep.
So again, those are just two simple things that I pointed out that are significantly disproportionately impacting folks. So that 43% Black homeownership in 1968, we had 41 in 2019. Zero progress.
Exactly. So we mentioned rent reporting. I'll just jump in there. And so just a simple tool is that just begin to, if you open up an account with MoCaFi, you can opt in to now start reporting your rent to the credit bureaus and see that works for you. You see your Vantage score going up every month. You see what's happening by you took an action. You said, I'm going to open up this mobile bank account. There's no cost to me. I'm now going to start reporting my rent and my utilities, seeing that work for me. And over time, by doing these actions, you will see how you then get into the financial ecosystem. And now you have access to more resources in the financial ecosystem. And you see the benefit of that working for you. And then there's a few questions over here in the chat. So another person mentioned, so, during these COVID times, there were a lot of federal and state and local subsidies like emergency rental assistance. And so the ARPA funds, American Rescue Plan, these funds municipalities were given to disperse to communities to help them get, over the COVID impacts that helped happen to them during the last year and a half. And so that's another way to get funds into the community quickly. And then again, educate them. So we've given you these funds. We're helping you pay back rent because you lost your job and you were in one of these industries like the restaurant industry or the retail industry that were decimated during these COVID times. We are going to give you a certain amount of funds for 6 months, 8 months, or whatever. And then if you use the FinTech platform for that, that's a way to, again, get information to you. So you're getting this fund, you're going to pay your bills, but if you save some here and put some in the savings pocket, and again, get on the journey to having a mindset of building wealth. So save a little bit here, pay your bills, record your bills, build your credit, then try to qualify for a home mortgage, then maybe get into a small business pocket. So there are opportunities with funds and money movement, I want to say, in the fintech space within these apps, using their resources and getting access to information that's at your fingertips, literally at your fingertips, at no cost to you.
Mm-hmm.
So just want to put that out there.
Yeah, and some of the common bonds between what you're saying, Christina, and Castleigh, and also Sharla, is that these are process shifts, but they're also power shifts. And this is kind of what makes fintech a testing ground for a lot of ideas for, big banks, big institutions that, either don't want to or don't have the inclination to do that kind of, technology outreach to people, right? And so I think it's kind of a running joke that it takes IT directors at big banks like 15 years just to switch over their version of Windows or whatever it is, right? Like people are working on old laptops, from that are from a previous generation. And so, but that's a real tension where there is a discomfort in mainstream banking, and maybe just by sheer size or scale, with having to change technology or having to embrace technology. And so I guess, the question there is, knowing that these process shifts are also power shifts, can fintechs make a difference to an industry that is sometimes reluctant to change until it's forced. And, and how can fintech make those differences? And what are the next frontiers, do you think? And then we'll take some questions from the audience.
I think the fact that fintechs have the opportunity to be flexible and nimble so that we can move faster. We don't have a lot of the red tape some of the larger entities and industries have. They have to go through a lot of bureaucracy, a lot of red tape. We are able to move with technology. We're able to move with like APIs and things like that. And so we really have the opportunity to be nimble and innovative with the technology and getting the information and sharing the information. So the fact that you are in the app, you're a client, and we can do a soft push in the app to share information with you on a daily basis, on a weekly basis, on a monthly basis. So you're getting this resource and this tool that's right there in front of you. But we're doing that because we're able to push this to you with a mobile app versus sending you something through the mail, using the postal service and postage. And we know the postal service has experienced a lot of delays, again, due to COVID during where we are. And so getting information and getting resources on a timely basis, time has been the essence. You know what I mean? We are providing some disaster relief for some of the hardest areas hit by Hurricane Ida. And we're able to do that because we're able to get that information, to get those funds on the ground digitally to you. So we can send you a traditional piece of plastic, but we can also send these funds to you through a digital first code so that it's downloaded into your mobile app. And I know people didn't have power, so there's ways to try to be flexible and nimble. So we're going to send cards to central locations so they can be passed out on the ground. And those that do still have a cell phone and have access can then get the money digitally. So how we're meeting consumers or meeting end users where they are and where the needs are in their space, whatever they're going through, we're trying to come to you versus having you go someplace else. So very granular, but it's a small thing, but it's a big thing, if you know what I mean.
Yeah, and I have said this already once, but I do love working with fintechs. They're so much fun because they are nimble and flexible. When I first started working in this space quite a bit, 10-ish years ago, the large FIs kind of didn't view fintechs really as a threat or as in fact, one story I love, right? And this was probably 4 or 5 years ago. A senior executive from a large FI said, "Oh, fintechs are just like a sandcastle. As soon as the first big wave comes, they're going to be washed away into the ocean." Now I regularly, like weekly, get large senior level executives from some very large financial institutions that want to talk with me because they want to understand what fintechs are doing. So fintechs are nimble and they're flexible and they're everything that she just said, but they're also going to drive that change because the larger institutions now are seeing them not as necessarily a threat or a something that's going to wash away, but really as how they can help them move forward. They understand they have legacy platforms and legacy systems and ways of doing things, but they also see the value of partnering and leveraging what fintechs are accomplishing. So, I'm really excited about the direction we're going. I think we're driving change. The industry has changed as far as the perception in this space. And we really are we can really make a difference in what we are doing. So that's what I'm excited about.
Does anyone else want to jump in on that?
Yeah, I mean, I think there, Christina used the example, I mentioned the example of bank fees earlier, and I think it's a really good one to point to. Egregious overdraft fees have been a fact of retail banking for forever, but there's really fintech neobanks like a MoCaFi, like Chime, like Current, others that help put those fees directly into the crosshairs for consumers now even Congress. And I think, pushing the banks on where is the line between necessary to serve and predatory. Now we see kind of ally banks drop the overdraft fees, and I bet we see others follow suit. And similar dynamics at play with trading fees, maybe a little bit less of a egregious thing, but still, fintechs do move business models by changing price and collecting consumers as a result. And I think, one thing that's cool about this era of online financial services is anyone can switch to those providers that are giving them better service. So you're not beholden to a place where you necessarily can go in yourself. Small banks and credit unions continue to serve a very important role, but it is no longer the only option for you. And so if you find that you are being mistreated by a bank, you can go online and actually access those services that are trying a different business model or have more intention, as Cassie noted. So I think that's a really cool era, part of this era that we're in now. It's just more competition for users on the basis of treating them better.
Yeah. And, and I think also one thing to your point, Hannah, and to your point, Sharla, one thing that we've seen is that banks almost don't do anything until somebody is nipping at their heels, right? So there's kind of a competitive reason for fintechs to help kind of change that. Castleigh, do you have any thoughts on that question, or?
I don't really have anything better to add, actually. They summed it all up, so.
Great. So we'll take some questions from the audience. So here's one question, and it's about influencers and reaching people through influencers, which I think is a really good question. And it says, how is the fintech industry engaging the followers of hugely impactful influencers such as Earn Your Leisure and Wall Street Trapper? I assume this person knows them pretty well, to reach newly energized people who have been traditionally financially marginalized, right? So, can you reach people through influencers and find some new spirit of participation there? Do you see a wave of change in marginalized people seeking to advocate for themselves economically? What do you think?
I can jump on that one quickly. So I think Earn Your Leisure is super popular in the younger millennial minority as well as non-minority community. And so they've built a great audience around financial inclusion, financial awareness. And, they have, great internal material as well as they bring in some experts to connect with their audience. And those experts speak the language of that community, right? So what you're going to end up finding is like, hip banks, whether it's, neobanks, again, MoCaFi, shout out to, Killer Mike's bank. I forgot what that one's, Greenwood, right? So Greenwood, other neobanks, as well as like, smaller traditional banks that want to tap into that market. I throw out like maybe a Capital One or maybe other ones that, are okay kind of being a little bit less traditional, not like your $2.3 trillion organizations, but your other organizations may say, hey, this is an organization, these are communities that I want to tap into, and these are people that already have the ear and the voice of those communities. So it's an acquisition channel, right? So it'd be an easy acquisition channel, a relatable channel, and their content is actually connecting with those communities, right? So it's an easier way to kind of plug in there. So you'll probably see, it's kind of almost like, hip hop artists who became super mainstream, right? Before hip hop wasn't as super mainstream. And then like, Louis Vuitton is with Jay-Z and Beyonce. You couldn't have seen that 25, 30 years ago. But I think over time, you'll see these influencers, these large institutions start to connect with these influencers like, hey, you're distilling, again, information in a way that's relatable to your audience. And we have products and services that can actually benefit your audience. How do we kind of connect those two? So you'll see some of that with Earn Your Leisure, Wall Street Trapper, whether it's, the trading houses, whether it's traditional financial institutions, and again, other services, insurance companies, super not cool, but they'll want to become cool. So they'll kind of probably connect with these organizations. And so you'll see some of that start to really move the needle in terms of really connecting with these marginalized communities around true access to capital. So it's coming.
Yeah, brand ambassadors. I'll piggyback off of that. So brand ambassadors working with these traditional organizations really are a way to access a different generation of people and think about financial awareness in a different way. And so you'll see a lot of partnerships like that, as Castleigh mentioned, a lot of big brands and financial brands looking for looking for ambassadors to endorse their brand that have a huge following, like a Jay-Z or a Beyonce or an Anthony Anderson or just any big brand, Taylor Swift or Rihanna. Really, they're passionate about a lot of these ESG type causes. And if they find a brand that they like and they believe in, they really want to become an ambassador for the brand. And that just gets the awareness out there because they already have a huge following. And these traditional financial conservative brands are now in a new space in the TikTok generation that would not have been something that they would have looked at 5 years ago, but they really have to seriously be intentional and think about a go forward strategy in this space. So.
Yeah. Hannah, Sharla, do you have thoughts on that?
I would just say, I think that I talk to a lot of really early stage startups, and I'm really excited about some of the things that I'm hearing that are coming out that are going to leverage a lot of these influencers moving forward, because I truly think that's how we influence the younger generation to really help them understand this space. So I can't give any secrets away, but I can tell you I've had some great conversations lately, and I've learned a lot about what's out there and what's available. And there's some really great startups coming up that really are focused specifically on that space as well. So
I do have a follow-up question about that, which is that, if you're kind of using influencers or relying on that to kind of get the message out, there is a difference between awareness and responsibility. I'm a pretty active social media user, right? And so, there's always the risk of context collapse, right? Like there's only so much you can fit on a tile or in a caption. And, people might not know what they're getting into, what we talked about before. So how do you design or think about kind of that influencer outreach or strategy in such a way that you can preserve a sense of responsibility or seriousness about these products and what they might mean to somebody's financial health?
That's an incredible question. And I think it's so important because a lot of these influencers don't necessarily, there's no regulation over what they're saying or doing. It's going to really require, I think, the industry as a whole to make sure that the messages that are getting out there are the accurate ones, really, because that's going to be important. And certainly for anybody looking to partner with these influencers, really making sure that that message is clear and the right message, which goes back to our conversation earlier around transparency, right? It's transparency on your contract and what it means to you, but also the messaging that you as a company, I look at influencers as any part of your company's PR program. You've got to make sure that you're still giving that right message out. But a lot of work to do there. I agree.
Yeah. So designed choreographed TikTok dances may not necessarily be the best approach for a good fintech app, is what you're saying?
Maybe not in my world, but yes, maybe.
I mean, again, the dance routine might be dope. So that's not the worry. It's what you say in the dance routine.
Exactly.
The words that are going to be the
verbiage, right?
Yeah, the verbiage. Right. It's cute. It's funny. But then legal and compliance are going to come and say these 5 words only.
Exactly.
From these 5 words, we will have a problem. So I think that's where the influencers, and when you come to like larger traditional organizations, it's going to be a little challenging because influencers typically have authenticity, right? They have the connection of the audience. They have their particular way of communicating, speaking, etc. And when you get into large financial organizations and partnering with them, there's a regulatory kind of guideline that you have to follow. So then now to have that influencer kind of absorb that, authenticate it, and then distill it in their way within the framework that legal and compliance signed off on, as well as your marketing team signed off on. Again, that kind of just puts you in like almost like a golden handcuff. Like, yes, you have this great partnership with this large organization, but you literally can only say 5 words. The 6th word gets you fired. So I think it's kind of really interesting how that evolves over time and how you'll be able to, again, because there is reason for people to, have, a little bit, again, guidelines in terms of what they can and can't say to not be misleading, right? But in terms of, how you still connect with that authenticity, why you wanted to connect with the influencer as a large organization in the first place is a bit of a challenge that we'll figure out over the next 3 to 5 years, I think will be very interesting.
Yeah. And, oh, sorry, go ahead.
Just a very quick comment. If you go to the, Chime's done a big TikTok strategy. And if you go to the comment section under any of those, it's pretty much just like, this is really corny. So there's still some work to be done in terms of traditional banks partnering with influencers, to Cassie's point.
Yeah. And, and to that point, right, I think we saw earlier this year, the Robinhood situation showed that, you can't just control the direct outreach to consumers, right? There's a third-party discussion that can be hosted on a subreddit or, in Instagram comments that you can't control, and and that can lead to chaos, as it very much did with Reddit. So we're actually out of time. There is one question that I'd like to kind of propose to you, if you can answer with just a couple of words. How can other fintechs support this kind of work, support this financial inclusion work, in your opinion? I'd like each of you to say just a few words on that.
Sharing the story. I would say sharing the story, getting the word out. The more people we can share the story with about mobility, about MoCaFi, that would be great. And so that's how you could help MoCaFi.
Yep, and fintechs, partnering with fintechs to get that word out. I think that's really the key, is really understanding what options are available for consumers across the spectrum.
For me, aligning incentives, just being truthful, your North Star, and trying to provide as much value as you can to as many people as you can.
For me, if you're a fintech company, onboard your employees with a history lesson. I think it's really important. Understand the ways people have, things have gone wrong in the past, and try to avoid them in the future.
Excellent. All right, great. Well, I want to thank our panelists for a great discussion. I also want to thank FinTech Sandbox again for hosting us, and for the conference for being so lively, and for the audience for tuning in. So have a great afternoon, everybody, and I hope you have a really engaged time for the rest of the afternoon here.
Thank you. Bye.
Thank you, Heidi. Thank you, FinTech.